Client Finance is on with Financially Fit today, and we're going to do a market close. And we were actually talking for about, I don't know, man, we were talking about 2 hours probably.
A good chat to get going already.
Yeah, man, it was good. Definitely nice to kind of hear another value investor talking about opportunities in the market and talking about what's going on in the world. So kind of tell me a little bit about your channel and we'll kind of get into how we met.
Yeah, absolutely. Well, first of all, thank you for having me, and I want to welcome anyone who's about to come in, join us on the chat. But Blue Lion Finance, it's all about dividend investing, value investing. I am the type of investor who I want to play it, very prudently as I invest. I like to sleep at night, and I started my channel, Blue Lion Finance, actually with just one goal in mind, and that was to help one investor per day. So, in terms of where I sit, I'm not so concerned about even monetizing my channel. When I get that like, or when I get that comment that says, X, Y, and Z, recommendation helps me, that's the biggest reward, and that's what I still run with today on the Blue Lion Finance channel, just to help investors. I hate to see, newer investors throwing their money in the market and losing and then backing away from even investing. So that's how Blue Lion Finance started. But let's get financially fit as well here. I'd love to know, how you started and why.
Yeah, so was in financial services for a little while and just realized that I didn't feel like I was doing what was best for kind of the clients that I was in front of. It felt more like a sales job. It wasn't really about financial literacy, and just kind of wasn't what I signed up for. So I decided to just start the channel and just talk about basic finances. We talked earlier about we both got on the bad side of things where, certain stocks that blew up our channel was probably, the worst thing that could happen, So, that happened. So basically just wanted to teach people about, kind of how to approach investing, about, really digging into the stocks, numbers, and figuring out if the economic backdrop aligns with that. And what we're starting to see, and I think, we were talking about it earlier, was there's a lot of YouTubers out there pumping stocks that, are very popular within the community, but unfortunately they don't have good fundamentals behind them. And whether that's, they're not going to be cash flowing for 5 or 6 years. And now we're talking about an interest rate environment that's going up. So, there's a liquidity crunch there that they can't get capital. And so I wanted to kind of be a voice of reason within all of that and say, hey, this is me just being unbiased and looking at companies, and this is what I think that they're worth, just looking at the fundamentals and taking my emotions and the story out of the equation. So that's kind of how I started this channel. Super glad we met, because I watched your channel and I just felt like you come across extremely genuine. And I think that you do a great job of kind of giving the backstory, a lot of these companies and where they come from. And so do you mainly invest in dividend aristocrats? Is that kind of like the criteria?
So it's a part of the criteria, at least for me. Definitely my channel is dividend investing, focused. That's not to say I don't have any growth stocks. I do hold some growth stocks, but predominantly it is dividend investments. And, the reason being, I've been saying this a whole lot lately. Number one, it pays to be patient. And number two, I'm not looking to kind of throw those stocks out there that you actually mentioned a lot of YouTubers are throwing out. And I like to call them the get-rich-quick stocks, where perhaps they're not even good investments. The fundamentals are off. So then you get those beginner investors who are jumping in on them, wondering why their accounts aren't growing, and they end up losing. So for me, as a dividend investor, I usually start off by looking at, dividend aristocrats, dividend kings even, and sifting through those lists. Mm-hmm. Of course, I have like my core investments, whether it's the Apples, the Johnson & Johnsons, the Realty Incomes. But I'm constantly sifting through dividend investment lists and taking a look at, what's undervalued. And if I can get in right now and just hold, collect on the dividends and watch the share price rise over time. I mean, that's my goal.
And guys, if you're coming in here, appreciate a thumbs up. And we were talking earlier about the opportunity that we see at hand, and we both were kind of on the same page that looking at, kind of the financial industry as possibly the bigger banks that are well capitalized here. And just to give you guys kind of a run back here, the big banks actually had their stress test. JP Morgan, Bank of America, and Citigroup may need to cut buybacks, but overall stress tests came out really strong for the banks. So we're seeing finances lead the way today, which to me is no surprise, as there's so much uncertainty. And this is this is a time when you think there's so much unknown. You want to invest in companies that are well capitalized, that are cash flowing. And now that we have interest rates actually getting some separation here, gives a great opportunity for idled money in banks to do extremely well. Obviously you want to watch kind of the credit cards and things of that nature as, consumer credit is going up and consumer savings is coming down. But when we look at the grand scheme of things, the banks should be set up, if we get another leg down here, the banks should be set up to do extremely well and have plenty of liquidity to get through any sort of crisis here.
Just to double back on that, look, banks have been hit pretty hard throughout the past couple of years. I've been enjoying the valuations I've been looking at, but right now, looking at their valuations and realizing that yes, interest rates are on the rise. And this is what we already mentioned, a little bit earlier, was the fact that those rates going up ultimately mean banks are going to capitalize on net income. And from there, what does that mean? Better margins. Better margins means that stock share price is going up. So I am absolutely in love with banks right now. JP Morgan. It's not in my portfolio, to be honest with you, but Bank of America is. And I think I shared this with you earlier that Bank of America was projected 15 to 20% in terms of the increase this year. Contingent upon those rates. So
I would say that you don't even need to get cute with picking one individual bank. Just buying an index of the banks and maybe layering it on with a JP Morgan or a bank that you want some extra exposure to could be the way to go, because I think they're all going to do fairly well. And when we talk about the drawdown that we've had in this market, you don't have to pick the winners and losers. You could really start looking at the indexes, as the indexes are down 25, 30, 40% depending. Pick up a basket of stocks and don't try to pick the winners and losers in uncertain times. You're already buying them at a massive discount here. So we got my buddy Tom, who's on here. He loves dividend. He's a big time dividend investor. He actually, you were telling me about the pandemic when you bought Bank of America.
Sure.
And he went big on Ford at like $4 and $5. And wrote it up to 20 and, did very, very well with that. So big time dividend investor. Yeah. So that was a great investment. And then how often do you have to go out and adjust your dividend account? Once a day, a week, or a month? So I guess when your dividends are, supplied to you, do you just drip them, or are you adjusting your positions? Like, how do you handle the actual payments of your dividends?
It's a great question. I do use drip, of course. And actually, right now is an ideal time to use drip because of where the market is. However, if the market is going to go back up, I actually take drip off and I make sure that I am putting all that money into my settlement fund so I can reallocate as I see where it's needed. And I think that's important. Drip is very easy, of course, but I want to make sure that I'm always buying more dividend stocks on the discounts, or at least the valuations that I like. I think it's important for an investor to know that if the market's really rallying, be a little careful using drip. But as a dividend investor, predominantly I'm not looking at my portfolio all that much. And that's actually what I enjoy the most.
I would say that's the biggest problem that I have, and I think most people probably have, is that we're looking at our portfolio way too much. We're worried, like we were saying earlier, you're looking at the ticker, you're not looking at the actual company. So it's like, we were talking about Citigroup, Citigroup sitting at, I'm thinking I'm getting it at a great buy at $47 and it goes down to 45. And I'm like, oh my God, I'm down 5%. And I just bought the damn thing. But I'm looking, when you have that behavior, you're looking at the ticker, you're not actually looking at the fundamental business, saying, I did my valuations. I think, it's a $55, $60 stock and I'm getting it at a pretty good discount, factor in dividends reinvested, not a bad return, probably going to outperform the market over the next 18 months. So, that's like definitely, that's the mentality you need to have is more of that longer term mindset. And, as long as you're doing your valuations and it makes sense, dollar cost average down. If the price gets that much cheaper, go back, make sure that everything's still in line with what you're trying to accomplish and the company's, achieving what they want to accomplish as well.
I want to touch upon that too, dollar cost averaging. I mean, an ideal strategy. However, if the market continues to plummet, right, you can always throw more into the market. You can dollar cost averaging when you see that ideal price. Go ahead, dump some more money, into that stock that you're already dollar cost averaging into. And, talk about emotional investing. It's one of the scariest things I think an investor can do. And again, that's why I started my channel, and perhaps why you also started yours, is just understanding that if we're going to be jumping onto to YouTube and listening to a lot of these YouTubers talk about, the latest, the hottest, maybe the sexiest stock that's out there, perhaps not the best fundamentals, but it's really exciting to get in right now. Mm-hmm. I caution every investor out there, because you got to be looking at the fundamentals. You got to be looking at the balance sheets, understanding what you're getting invested in. Let's be honest. I mean, it's really fun to be invested in, cryptos. It's really fun to be invested in Tesla. Yeah. However, oftentimes there's very lucrative plays: Johnson & Johnson, Coca-Cola, Procter & Gamble, Apple, Microsoft. So I caution, investors in that regard.
Yeah, it's the beta, right? The beta is extremely high. So you have these wild swings where in one day you can be up or down 15, 20%, but what's the true trajectory of the company? What are you really buying? Are you buying something that moves, the ticker's moving, or are you buying where the actual company is moving in the right direction? And those are two different questions, right? Like the ticker's one thing and the company is a whole nother. And for me personally, I tend to think that everything comes down to valuation. Like, everybody says, oh, are you a growth investor? Or are you a value investor? The bottom line is you need to be buying stocks at a certain price to where you're getting a capital appreciation. So we all are somewhat a value investor at the end of the day. And unfortunately, Wall Street knew that there was a lot of liquidity out there and started these SPAC deals and IPOs over the last 2 years of amounts unprecedented that we've never seen. And now you're starting to see these bubbles pop, and all these YouTubers are starting to get a lot of hate now because they never ran valuations on these companies. They were just, like you said, they were just the absolute popular name. We jumped on the ticker because what was happening, the stock IPO'd at $10 and went up to 50 or 60, or you look at a case like Robinhood, where it was like IPO'd at 11 and went up to $85 and it's at $7-8 now. Well, maybe today it's
look, anytime we're going parabolic on a stock, I am very, very cautious, and you often see that happen, right? Robinhood is a perfect example. They IPO, their stock soars, and the next thing you know, you have a lot of investors that are actually losing money. Yep. And I even hate to call, those jumping in a case like that investors, because for me, that's gambling. Yeah. I'm a big Warren Buffett guy. And to your point regarding, even emotional investing here, is something I always reflect back to that Buffett shares quite often, is that investing is like buying a farm, right? You're not going to buy a farm to buy it and sell it next Tuesday. You're going to buy a farm and hold on to it perhaps a decade to maybe even a generational purchase to hand down to, your kids. And I think that's important. That's actually how I look at my investments. I go in with the mentality that I'm not going to sell. Never sell stocks, I like to call them. But that's the mentality that if you really are looking to make the money, to hold on to these investments, then go in with the mentality that once you're in, you're in.
I think that's great. And as Susan pointed out, it was fun while it lasted, but the party is over. And I think we're seeing that right now. The party's definitely coming to an end. Once you start talking about money's no longer free, and you actually need some sort of business model. And, one of the areas that I look at when I'm looking at, reports is how you can tell a company has a competitive advantage is when the cost of goods are coming down or sales, general administration is coming down, but yet their top line's still growing. That's how you know a company has a competitive advantage. When they don't have to spend as much to outgrow other companies, they have an advantage. And unfortunately, with a lot of these SPACs, it's the complete opposite. They're spending more than they're actually making when you really look at the fundamentals. And you're right, Susan, the party is definitely coming to an end for a lot of these companies. You have to really trust management to deliver on some of these promises in an uncertain economy. And that's why your approach is something that is a little bit more simplistic, but it's also, these companies are not going anywhere. you don't have to, like you said, you can sleep at night. You don't have to worry, that it's your company's going bankrupt tomorrow. They can self-fund. They have cash flow. They have tons of cash on their balance sheet. They have multiple ways to tap into credit, where a lot of these other companies, the only way they're going to raise funds is through dilution, and that's going to only hurt the shareholders.
First of all, I love that, Susan. It was fun while it lasted and the party's over. If you're one of those investors who's the last man standing at a party, you never want to be that guy. That's honestly what I'm seeing across the board on YouTube when I go video to video to video, and I'm seeing what, commenters are saying about some of these hot stocks, if you will, on YouTube. They're oftentimes caught in the firing lines. They oftentimes are that last man standing at the party. That's an ugly scene. It also begs the question, Colton, what is your biggest position right now?
So for me, it is healthcare. I'm big into, I'm overweight healthcare right now. And, I do have some REITs. I think REITs are a good hedge to inflation. And I'm starting to build into the banks now. So I think the opportunity right now is with the banks. I think REITs are good hedge to inflation. I think healthcare is fairly cheap. And my largest position is obviously cash. I would say I'm active, to the fact that I look at the S&P and I think, over the next 4 quarters, it's projected to do about $233 of, earnings per share. So if we put a 15 multiple on that, the S&P should probably be trading between 34, 35, 3,600, right in that range there. So I felt like anything over that price to me was a little risky in this market when we consider a tightening process taking place. And then if we factor in possible recession, then I think you need to be looking closer to the low 32, 31, 3,000 level, as crazy as that sounds, depending on how deep of a recession we go. So for me, I look at the indexes first, and then look at what can outperform. I know that sounds a little kind of crazy, but it's my active approach to doing it. So within those sectors, I think is opportunity.
You shared it maybe a little bit crazy, right? But you know what? Your strategy is your strategy, and it's been working.
Yeah.
So I wouldn't even dare say that it's crazy. I think everybody, especially during these unprecedented and volatile times, has to have a strategy. I'm also cash heavy right now. With my largest position being Apple. A huge fan of Apple. And
well, they're not going anywhere. They're not going anywhere.
They're not going anywhere.
Yeah,
I've actually been buying Apple dollar cost. It's one of the dollar cost averaging companies I've been investing into in the last few weeks, and hopefully the market dips again so I can go ahead and buy more. But to your point with the recession, from your opinion, what happened this week? I mean, from where I was taking a look at, Monday, investors who were ready to go, ready to fly out of the chute on Tuesday morning. The markets were closed on Monday. I think, Jerome Powell spoke the previous week, and then we had the testimony again this week. But on Tuesday, we already started to rally. I was under the impression that we would get a very volatile week, and it's been quite the opposite, actually. So I'd love to get your take. I know we were talking about it a little bit earlier, but let's dive back into it.
Yeah, so I think what you're seeing repositioning taking place with a lot of people's portfolios, especially the hedge funds. I watched put and call ratios over the last few weeks, and it was heavy put volume coming in here. So the put volume, obviously the expirations, people, took profits. So you're starting to see, put call volumes get a little bit more equalized, which is going to cause a natural rally as we're down, pretty drastically overall. So you're going to get a natural bounce within the market. So I wouldn't say that today, especially when you look at a rally like today where everything was up across the board, I always question those days, right? Nothing fundamentally changed when we think about, we know that the Feds are going to come back out and raise rates again, right? We already know that. We still know that they have to let $95 billion worth of assets expire off their balance sheet. We don't know how the financial markets are actually going to respond to that, even to this point, right?
Rolling into to next week, we will have more inflationary data coming out next week. And, in terms of this week, we actually had a lot come out this week in terms of data. Jobless claims came out. We had existing home sales also came out. We had consumer sentiment come out on Friday. And, I'm very curious now after this week to see what's on the agenda for next week and how we're going to be reacting.
Yeah.
And,
it's been a weird reaction. It's like, like we were talking earlier, the Feds came out, right? And we already know we've had negative 1.5% GDP last quarter. And what happened in their last meeting is they said that GDP is going from 0.9 to 0. So we're going to have zero growth this quarter, which means that if we go negative, we're technically in a definition of a recession. We could be in a recession right now and they would just backdate it. And I tend to believe that we are in a mild recession already. And I'm not trying to be pessimistic. I'm just trying to give my 2 cents on.
This is what we spoke about before. There's nothing wrong, with being, more pessimistic right now, because that's the reality. And right now, I read a article that came out. 10 Americans, 6 of them believe that we're heading towards a recession.
Yeah,
that's just the reality. Consumer sentiment report that came out earlier today stated the same exact improvement on inflationary outlook, but we are right now, I believe, in a position where we need more data. First of all, we already know, and it looks like Powell will come back out and they're going to raise the rates by another 75 basis points. I think we will get a dip again once Powell comes back out. When the Fed speaks, the market shakes. Let's leave it at that. For those of you who don't know, I worked in real estate, and I worked for a pretty prominent real estate firm in Manhattan. So it wasn't necessarily on street. I lived on Wall Street. That's as close as I got to the bowl. And in terms of YouTubers, investors who are on YouTube, they're looking around. What do you think they're looking for when they're on YouTube in terms of the news and their intake of really economics? Because in my opinion, maybe it's just because I'm a value investor, a dividend investor, and I'm looking at the whole picture. I don't really see a lot of investors on YouTube really diving into the data.
Yeah.
And I think it's really important, at least at a macro level. Please, folks, dive into the data.
That's funny, Ari, because that's kind of what I think. I separate myself a little bit from most other people is I look at basic charts. Are we, did we have a massive technical breakdown from the charts? That's mainly what I look at. But I look at the economic backdrop and what could actually outperform due to the economic backdrop. So we talk about high inflation. We talk about medical needed more than ever with what's going on globally right now. Political tension. So what kind of stocks are going to actually outperform during those types of downward movements? Well, we talked about inflation. Some of these REITs might be a good hedge to inflation. Some of these healthcare stocks that actually start selling off that have great fundamentals and great pipelines, that we need these products in the near future, could be a great hedge too. So I do look at the economic backdrop. So it's funny you bring that up because, I was telling you the biggest problem I have with my channel is do I go lighthearted and be entertaining, or do I actually give good sound advice and be more serious? Because it's I'm not good enough to do both. That's a tough thing to do, go back and forth.
Sure.
And I feel like I'm pretty good at digesting economic data and being able to relay it to how it could translate into the stock market. And I think that's probably one of the things I do a little bit different, I would say. So I wanted to thank you because that actually puts clarity on kind of what I try to do here.
Yeah, no, look, and we spoke about this a little earlier, right? I had the same exact troubles where it's almost this balancing act, right? Because you're on YouTube and, as someone who really wants to be a form of a financial coach, or at least someone you can look to, a beacon of light to say hey, this is a value investor who's playing it safe and that strategy is working, versus the guy who's popping off names of stocks just to try to get the views on my channel, know, and it's silly to me. And I'm not going to, drop names here and talk about.
Oh, we could drop names. We could drop names.
I know me and you at one point.
We could drop names. I'm not too worried about that. So, but no, man, I agree because it's I wouldn't say it's, I'm going to be honest. It's a little bit of a jealousy factor because it's you see some people that are pumping these stocks that they shouldn't even be talking about. First off, that there's no fundamentals backing these companies, and then you go into your channel and you're talking about something that nobody's searching for because nobody thinks it's a 10x stock. And it's yeah, exactly. And it's so frustrating because you're but I'm giving you so much more material here than just being cheerleading some garbage stock. But it's just, it's what the public likes. It's unfortunate. People are interested. People are more interested in kind of the 10x move instead of a predictable way to kind of create retirement for themselves. It's unfortunate, but it's But it's,
Well,
hey, Adam, appreciate it.
Here's what's interesting. When we first spoke over the phone a couple days ago, right? And I was talking about these, people who are trying to get rich quick. I like to say get rich by Tuesday.
Yeah.
And if that's your approach, please, get another one.
Hey, well, if it works, man, God bless you,
What I appreciate that you shared on the phone was that, a lot of it actually comes down to these newer applications like Robinhood and Webull, where you get a really, trigger finger happy young investor, and they're clicking away on what's hot because they just heard. Again,
so I'm gonna no, dude, I'm so glad you brought this up. So we talked on the phone before we decided to go live today, and I brought up, we have a similar thought process because we're both, we both think that there's some economic turmoil. We kind of read the data and digest it very similarly. We both look at value over kind of the story, and what's happened is Wall Street has built a casino. Wall Street has built a casino of brokerages. And the reason why they've done that is because the money is not in buying and holding for Wall Street. The money is in transactions, right? That's where the money is. Every time you buy and sell, they're getting a piece of that. They're getting the buy and sell orders at better prices than so they're taking those profits, right? So they need to treat it, they need it to be engaging for you and make you want to trade. And that's why you see the bells ringing. That's why you hear the bells ring, and that's why the lights are flashing, because they want you to get that dopamine to start being emotional about your investments. Because at the end of the day, it's one or two ways they're going to get your money. Either A, they're going to get it because you're doing 15 transactions a day and you're losing. And then B, they're going to get you from assets under management because you're finally going to give up because you're not a good trader, and they're going to take your assets regardless. So it's a win-win for Wall Street to create these platforms for people to feel like they're gambling, and eventually they go broke. And eventually they give up on taking the path that they could have took themselves and have control over their own financial freedom, and they hand it over to that brokerage anyway.
It's a sad story. I'm gonna ask you now, man. Reveal the truth. Do you have Robinhood or Webull?
No. Okay. I've downloaded the app and I've used the news feeds, because I will say this. I will say Robinhood's assets is the fact that the news feeds are pretty friggin' phenomenal in some of those apps. I use TD Ameritrade, man.
Okay.
It syncs to my phone, so I could be out with my girlfriend, and all of a sudden 3M's hits that 115 mark.
Don't ruin the date.
No, it ruins the date. Yeah, but hey, it's you get a deal. My girlfriend knows I'm cheap, so it's like, hold on a second.
So, you are not cheap. You are frugal. Come on.
Frugal. I try to tell her that, man. She doesn't always agree with me, but.
Look,
I get mad. Ari, I get mad. I need to own Amazon because I know the guy's name that comes to our door every day for my girlfriend. So it's like, buy Amazon.
Now you feel you own just a little bit of him, right?
Yeah, I'm like, every time he's coming to the door, I'm like, well, at least I'm getting it back some way. It
might put that package in the right place.
Yeah. But
drop it gently. No. Look, speaking about Amazon though. Talk about Amazon stock right now. What are your thoughts? Because what I'm looking at is an opportunity when it comes to Amazon. Likewise, again, with Microsoft, Apple, Google for that matter. I know Tesla's in that mix, and I know your feelings about Tesla.
I'm not huge on the car industry right now. When we think about where we're heading in the economy right now, my girlfriend's on. She heard that, so. She got the little smiley face there.
Is this Nicole?
Yeah, Nicole. She's listening. So
I will share right now that
I love you, babe. I don't mean anything by it.
If Colton pulls his phone out again on a date, I won't do another live stream with him.
She knows. I love I love following like the economics of. I'm obsessed with the economics of things and how it translates to opportunities for individual stocks. That's kind of where I'm super passionate about that. Companies like we were saying, Amazon and Apple and Facebook being down 40-50%,
Facebook.
Yeah, dude, just buy the index that's made up of these companies. Don't try to pick the winners and go overweight, because what's going to happen is, if $5,000 is a lot to you and you buy Facebook, if you bought Facebook at $200 because it was probably, intrinsic value for Facebook's probably right around $200 right now. So if you bought Facebook at $200 and you put $5,000 into it and it dips to like 150, you're sitting there like, that might be a lot and that might be too much for you to handle. Just buy the indexes that are overweight Facebook, Amazon, and Apple right now. You don't have to pick the winners. The market's given you the opportunity, take it while it's there. And then once we get more of a normalized market, try to pick the winners then. But this is not
a market. Or that beginner investor who perhaps maybe just joined us, or you've been watching and listening in. When it comes to a play like Facebook, to your point, investing $5,000 in Facebook, $200 per share, and it dips.
Yeah.
That emotional turmoil in your stomach. I mean, I can almost guarantee I would sell as a beginner investor. And I think that's very scary in recognizing that even before I just recently moved outside the United States, but before I moved, I had a really good buddy of mine who was watching Facebook stock plummet. And he goes, I'm buying Facebook. And I said, well, what's your experience with investing thus far? And he goes, I don't even have a brokerage account. So I said, look, let's do this. Let's just set you up, right, with a Vanguard account and dabble maybe a little bit here and there with a Facebook or, another hot stock, but build a foundation, at least for yourself, with an index fund or an ETF. And I really like to run with Bogle's advice when it comes to index investing, which is find yourself a broad market index fund that covers the entire market. And it's going to give you, opportunity to be invested in growth stocks, value stocks, small, mid, and large cap opportunities that if you just throw all your eggs into Facebook and that stock dips, you tell me how your stomach is feeling.
I mean, and you never know what can happen, man. You just never know what can happen. Right now is a great time to buy indexes because the markets are just down. They're giving you free money right now. The market's giving you free money because most of these indexes are paying more than you're going to get in a 1-year yield anyway. So lock up your money for 12 months in one of these indexes, get a 2-3% dividend, and own a basket of good quality companies and start from there, and then start diving into those individual companies that are in the index. Go through the quarterly reports, listen to the quarterly reports, go through the financial statements. And once you start educating yourself on that, maybe start dabbling 5-10% into individual stocks that you feel like you've done your due diligence on, But I think we get so excited to, it's unfortunate, but YouTube, the community, it's not even just YouTube, it's just the get rich quick mantra is just, it's everywhere. TikTok, YouTube, everywhere. And so everybody wants to put all their money in one company and think it's going to 10X. And it's just, unfortunately, you're talking about very few companies that do this.
I've said it before, I'm going to say it again. It pays to be patient. And, when it comes to index investing, that's actually how I started off. And I built myself a foundation. I like to call it a foundation. $10,000. I just kept throwing money into an index fund. And from there, as I built more confidence in myself as an investor and also realized and studied strategies, which one is going to be best for me.
That's a good point.
That's important as well to really understand the strategies and then to implement the one that feels best for you as an investor. And then I started buying individual stocks. And now the way my portfolio is looking, I think it's beautifully built. I probably have a biased opinion, but to each their own, and
I think just from our conversation, I think you're well diversified. You buy good quality companies on the dips, and you have criteria that they have to meet. And you made a good point. Pick a process that works for you, because at the end of the day, and I've said this a million times, I can make fun of these other YouTubers, right? But if they make 200 or 300%, the scoreboard is your brokerage account, right? So they won. The scoreboard says you won because you've got X returns. Now, is that sustainable over a long period of time? Probably not. So the scoreboard's forever going here, but the scoreboard says you're winning right now. But if you have a process that's calculated and you can understand and it works for you, regardless if you're a growth investor, dividend investor, because I hear people talk bad about dividends sometimes because it's not the most tax efficient way, and
you get a lot of heat.
Yeah, you get a lot of heat for that, right? But what I would say to that is, if their process works, who cares? Like if their gains are pacing the market or even outpacing the market, then in the end, it's like that process is working for that individual, right? So I don't judge anybody's process. If somebody's day trading and they're making 40% a year, the scoreboard says you're winning, man. Like, so God bless you, you know, like keep at it.
Look, I completely agree. And it actually wraps me up into this point in that while we're waiting, okay, we're in bear market territory right now, right? Down 23, 25% or so.
Yep.
And the recessionary downfall would be, correct me if I'm wrong, maybe like 35% of the dip.
Yeah,
so
roughly.
We're talking about some time right now where I think investors, and this is what I love, investors have an opportunity. I mean, let's be opportunistic here. We have an opportunity of a lifetime to get our hands on not the Palantirs, okay? The Apples and the Microsofts that are rarely discounted. Apple's about 24% down off its high this year. That is a rare opportunity. Microsoft, very similar levels. Google, I mean, they're all at these levels in which if we buy in right now, play it safe, be patient, that return will come. And you may be one of those live stream followers prepared to thank Colton and I in the future. And that's just my opinion.
Seriously. and you're actually bringing up a good point. And you can have an emotional feeling. I'm emotional about Airbnb, but the fundamentals are also very strong that are developing in that company. So, you know, that has to go hand in hand. But to get to your point, it was picking stocks, right? We're talking about picking stocks that need capital, okay? Talk about a recipe for disaster. Picking stocks that are running out of capital because their burn rate is so high into a tightening economy makes absolutely no sense. If a company is not free cash flowing and interest rates are rising and inflation is rising and cost of goods being sold is rising, you don't buy companies that can't free cash flow and that don't have a competitive advantage. You just don't do it. That's my rant, man. Financial education, man. Every time I watch him, I feel like here's the thing, like
remedial financial education. I don't know.
He's got a ton of subscribers. He's charismatic. I can't say I don't know as far as knows what he's talking about.
Flip side of this coin, I do want to mention a great channel that I stumbled across not too long ago. Everything Money.
Yeah.
It's a team of 3 guys, and they do a phenomenal.
They got such a professional setup, dude. I'm like,
I wish I had
so
it.
Jealous.
I open and transparent with everybody here, right? I was in New York, in Manhattan, and I just moved into an apartment with at the time my girlfriend, and I was thinking about creating this YouTube studio and a TV and get the whole thing going. And I said, I'll wait. And I had moved back from international, being international to back to the States. We broke up in like 3 months, 4 months later from that. And
it happens, man. It happens.
Back out and head out of the United States. So I never built the studio, but that is the one thing I think that's coming down the pipe. And we'll see a professional studio, a nice TV in the back. I did just start a job at Tip Ranks. And I'm
congratulations, man. That's awesome.
Yeah,
you're gonna have to pass down any nuggets
now for Tip Ranks.
So you're gonna have to pass down any nuggets, bro. Anytime you hear something, just pass it along.
Which is good. So we'll see what happens.
I'm glad we were able to do this, and we'll have to come on and do it again. And guys, consider subscribing to my channel. Consider subscribing to Blue Lion Finance, and we'll definitely try to get this done again. As always, guys, appreciate your time, and we will see you next time, investors.